Hi everyone, my name is Piterpakulski. Today we will continue building financial model for a bakery. And today we have a very interesting topic. We will be modeling internal rate of return. Um, what is internal rate of return? Internal rate of return is the discount rate which converts net present value to zero. And what is interesting about many models, so many times, so there are a lot of models that are shown on the YouTube, and they are calculated with a step of projections like a year. So for example, we have year 1, year 2, year 3, year 4, and sometimes you may calculate internal rate of return not accurate. But so if you want to calculate the internal rate of return accurately, you have to dive into monthly calculations. And for example, if your project has multi-investment stage, so for example, it is not so simple as, for example, investment stage, then for example operating activity stage. For example, you have some investment stage, then operating stage, then inside operating stage you have some additional investments, and in that case you will you may face that you will need some another algorithm to calculate internal rate of return. Sometimes, for example, it is useless to calculate the project with step of projections equals to when it equals to 1 year, because you will not be able to see the operating losses during the first year of operating activity. So you will lose an additional amount of financing needed for operating losses coverage. So if we look at any model, so sometimes if we calculate yearly it is useless, but if then we need to calculate monthly. And for monthly calculations I can show you how you can calculate the internal rate of return. So like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the links to the playlist where I will be keeping all these tutorials, and when I completely finish this model I will give you all the links in the description of this video as well, so you may watch for free one tutorial after another. So let's quickly run what we did before during our previous tutorials. So we have our inputs. We have a unique rule in our model, which means that all inputs are colored with blue, so like this. So these are the inputs, these are the inputs, these are the inputs. All other cells are formulas, so we're not touching them. So we start with naming all the types of breads and cakes that we produce. We can switch them on and off. Here is the sales plan with coefficient. This is the pricing with coefficient. We have different types of customers. We can allocate the revenues between these customers. We can specify the average check for different types of customers. We can switch them on and off from calculations. Here we have the list of ingredients with their prices. We can switch them on and off. We can increase and decrease direct expenses here. So here we can specify when we're starting an operating activity. Then we are specifying how fast we are reaching the target rate revenues for each type of customer. Then we describe fixed costs inside the typical years. We have global and local coefficients. We can switch them on and off from calculations. Then we have payroll with positions, salaries, amounts of people on each position, coefficients, switching on and off buttons. Then we have investment plan with coefficients and on and off buttons. Here we have the loan amounts, term of loan, interest rate, when we get this loan, grace period for interest and principal payments. Then we have tax rates. Then we are building cash flow statement, amount of financing we are calculating. Then we calculate simple and discounted payback periods. Here we have the recipes for our product line. So these are the products from top to the bottom, from left to the right. We have the ingredients, and here we specify how much of this or that ingredient do we need to cook 1 unit of this or that product. So for example, for one bread type 1 we need 5 units of ingredient number 1 and 8 units of ingredient number 15. So this is how it works. And now let's move to internal rate of return calculation. So let's create a new block, a new tab. So first of all, let's pick the discount rate. We will put it a little bit closer. So for example, let's go to the model tab. So here we will press equals, pull this data from this place. This will be no longer the input anymore. Now we will place here net present value. Net present value will come from this tab, from discounted payback period. This will be the cell for internal rate of return. This will be percentage format. Then the step of adjustment for internal rate of discount rate we will put here. This will be the input. So this is the input, so I'm coloring it with blue. So what I'm doing now, here I will be placing the discount rates. I will be starting with, for example, 0. This will be the input, and I will be adding this step. So let's create 1,000 lines for this table. So here I will put net present value. Now I'm gonna select this tab. I will go to data, what if analysis, data table, then I will go here and put here the discount rate. Then I will press OK. So I will assign, let's say, let's change format. So here we can see the discount rate and the level of net present value for this discount rate. So when discount rate becomes, when this NPV, net present value, becomes negative, this is the internal rate of return for monthly calculated model. So we're not calculating yearly. So that's what we are fighting for. So now we can, so we need to find this moment to put this value, 43% of internal rate of return here. So what I will do now, so if this value is less than 0, I will put this discount rate, otherwise 0. Oh, I will put, just a second, I will put, no, if this one I will put 1, otherwise 0. Okay, for this cell I will write a formula. So if and if this value equals to 0 and this value is more than 0, we will put here 0. The next part of this formula will be, if this is 0 and this is less or equals to 0, we will put 1, otherwise 1. Let's close these brackets and extrapolate this formula to the bottom. So now we've just found one starting with 43% of discount rate, and the discount rate will be, so if this equals to 1, we will put this discount rate, otherwise 0. So this will be the formula for the first line, and for the second line the formula will be if this equals to 0 and this equals to 1, we will put this discount rate, otherwise 0. So if this one is equals to 0, if it equals to 1, we will put this. Now let's extrapolate this formula to the bottom. So now we can see in this moment we've described this moment in this formula. If this is equals to 1, this is 0, and this is equals to 1, then we put this discount rate. And what we will do now, we will just create a total of this line. So now we are done with our discount rate. So this is the net present value. So for example, just a second. So for example, if we want to for example decrease the revenues, pricing, let's decrease the revenues, let's take 80% of pricing. We can go here. We can see that we have negative net present value. Let's go back, for example, take 90%. Still we have negative. So here we can see the internal rate of return will be 20%. Or for example, if we increase the revenues, for example, on 20% from our base scenario, we can go back and see how the internal rate of return will grow. Here it is. So now you know how you can calculate internal rate of return monthly, not yearly, but monthly. I hope you enjoyed this video. Give us a like, please. Share this video with your friends. Like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will be keeping all these tutorials. And when I finish this model completely, I will give you all the links in the description of this video as well, so you will be able to watch all tutorials from scratch, one by one, absolutely free. So thank you guys for watching. See you next videos. Thank you and bye.